The United States has announced new tariffs on a significant portion of its imports. These tariffs, affecting roughly 15% of all goods coming into the country, represent a substantial increase in import taxes. This move is expected to have wide-ranging consequences for the US economy, potentially slowing growth and fueling inflation. The tariffs are being imposed on a variety of goods, including cars, steel, and aluminum. However, key commodities like oil and natural gas are exempt. Experts believe these tariffs could push the US economy closer to a recession while exacerbating already high inflation. The stock market, often a gauge of investor sentiment about the future, has reacted with volatility to the tariff announcements. While some investors remain hopeful that negotiations and policy adjustments could mitigate the negative impacts, uncertainty persists. Adding to the economic uncertainty is the looming maturity of $7 trillion in US government bonds. This unprecedented figure represents a significant amount of debt that will need to be refinanced. The outcome of this refinancing will depend heavily on interest rates and investor appetite for US debt. Potential interest rate cuts by the Federal Reserve could make refinancing this debt more manageable. Lower interest rates typically make bonds more attractive to investors, as the return on other investments like stocks becomes comparatively less appealing. However, the sheer volume of bonds needing refinancing presents a challenge. If investor demand is insufficient, the government may be forced to offer higher interest rates to attract buyers, potentially increasing the cost of borrowing for the US government and impacting interest rates across the economy. The combined impact of new tariffs and the massive bond refinancing creates a complex and uncertain outlook for stock markets globally. In the US, volatility is expected as investors grapple with recession fears and the potential for prolonged inflation. European markets are also likely to feel the effects, particularly in sectors heavily reliant on trade with the US. Uncertainty regarding US policy and the potential for retaliatory tariffs adds to the complexity. Australia, while geographically distant, is not immune to these global headwinds. The country's reliance on global trade means that any slowdown in the US or Europe will likely impact its economy and consequently its stock market. Amidst the market turbulence, bonds, particularly those with intermediate maturities, may offer investors a degree of stability and diversification. If the Federal Reserve cuts interest rates, as many analysts predict, bond prices could rise, benefiting investors who hold these assets. However, it is crucial to remember that all investments carry inherent risks. Inflation, for example, can erode the value of bond returns over time. It is essential for investors to consider their own financial circumstances, risk tolerance, and investment goals when making investment decisions. Diversification remains paramount. Holding a mix of assets, including stocks, bonds, and potentially other asset classes, can help mitigate risk and potentially enhance returns over the long term. Consulting with a financial advisor can provide personalized guidance tailored to your specific situation.